First, we're going to be looking at Buy Now, Pay Later, which, as you know, is an increasingly mature and competitive area within fintech. So mature that, in fact, only 2 months ago, the UK government published draft legislation that would give the FCA regulatory powers over Buy Now, Pay Later. So we're going to hear now what this means for the industry and whether the legislation will better protect vulnerable customers. Please welcome, fresh from a stage session on the old library stage, the CEO of Zopa, Jaidev Janardana, and the fintech reporter at Sifted, Amy O'Brien. Welcome.
And the love kick starts again. Starts again. And the love kick starts again. Starts again. Kick starts again. Start to think it could be finished.
A bit tricky to know where to sit just then. So hey Jaidev, nice to see you on stage again. So today we're talking about BNPL regulation. And just in case people in the audience don't know, Zopa acquired DivideBuy, which is a point of sale buy now, pay later provider in February. I understand that that acquisition is now complete.
This is correct, yeah.
So before we start talking a bit about the wider regulation topic, I wanted to just ask a bit about how your buy now, pay later offering is going to be structured.
Yeah.
So my understanding is that it's on larger purchase sizes than what we're used to seeing with the likes of Klarna's average purchase size, etc. You're going to start at 250 and go up to 30K.
This is correct. So from our standpoint, of course, we've been in the business of lending to customers for a long time, and for us, the consumer rationale for actually taking finance or taking credit for something that requires you to save for quite a few months makes a lot of sense. Of course, customers love the 0% part of it. Customers also like the fact that they can compartmentalize their spending. So lots of things to like about it, and I'll come back to some of the things that are not to like about. And that's why we are in this. But we only think it makes sense where the purchase size is large enough. So our target purchase size would be more like 800 to 1,000 pounds. In fact, the first purchase that was made funded by Zopa on a DivideBuy platform was a sofa worth 2,500 pounds, which again, from a customer standpoint, if you're getting 0% credit on that, and you're able to pay that over 10 to 12 months in a sofa that you might use for 3 to 4 years, makes a lot of sense. And for us as a provider, it makes a lot of sense to actually provide that finance.
And I'm interested because you obviously started offering credit cards in 2020, I think?
Yes.
Was this something that your customers were asking for? Why? Why set up buy now, pay later as well as your ordinary credit offering?
Yeah. So I think this is a trend that we actually did see from consumers. Is that desire? Two things actually. One, the desire to compartmentalize finances. You can see that in our savings product, for example, we have a smart saver where we let people create multiple pots. They're saving for something, and you can create a pot and save for that. Similarly, we've seen in borrowing that people want to say, I've bought that sofa, I want to pay it down over the next 6 months. And the best way to structure something like that is using a BNPL solution. And if you're doing that at point of sale, then you typically can get a merchant discount on that just to be able to actually fund that finance. So we did see that consumers did have that need. Often they also want to use a revolving line of credit for the credit card. So both those needs exist, and thus we wanted to be able to serve that.
And for example, if a customer is using a Zopa credit card, potentially is near to maxing out,
right?
And then they also begin using the buy now, pay later loans, how are you going to manage that, and how is that sort of incorporated into your underwriting? Perfect,
it's a great lesson. I talked about what are the things to like about BNPL. I think that's one of the things that I think historically hasn't been that good, or it wasn't something that we should like about it, which is the fact that before this credit was extended to customers, often the right credit checks and affordability checks were not done. We've always said, and I think I talked about this about 6 to 8 months ago in another conference about the fact that when we are doing BNPL, we want to make sure that we treat it as credit, because ultimately the customer is borrowing money, they need to repay it. So the customer needs to know that in the promotion, but we as a provider needs to make sure that we do the appropriate checks, typically looking at their credit bureau, and make sure that the lending is responsible and affordable. So in this case that you talked about, if we feel that the customer has maxed out the credit card, then they will be declined for that credit offering.
And I'm interested, obviously at the moment, cost of living, we've seen all the data, all the articles with debt charities expressing concerns about the fact that this form of lending is absolutely soaring right now. I'm interested because you're offering like much larger purchase sizes. If somebody is buying a product of 30K, that's some people's salary for the year. They might lose their jobs. We've seen the layoffs in the tech sector, for example. So how are you incorporating that risk into the checks at the beginning, because their financial situation could change?
Of course. So when we make the decision to lend, what we want to do is that there is no foreseeable reason that the customer might be in detriment or harm. We of course understand that there can be unforeseeable things that happen that could lead the customer to be in distress, and that is true for all lending, right? And we have been, as Zopa, as a bank, we have been operating for 2.5 years, but as we have been lending now for more than 15 years. So it's a risk we fully understand, and for us, it's really about making sure that where we can take into account forward-looking data around inflation, affordability, we take that into account. We cannot always predict who's going to keep or lose a job, for example, right? And in those cases, what we need to make sure is that we treat that customer with respect. We make sure that they make choices in that situation, which is now different, in a way that is appropriate for them and affordable for them. And that means we always say to those customers who fall into difficulty that if you have priority payments to be made, be that paying your electricity bill, clearly food, mortgages, do that first. And if anything is left, we will take it. If nothing is left, then we will write off that loan, because that is the right thing to do under those circumstances. And that's a risk we understand. We have been doing that for 17 years, and have a great track record of both actually producing good economics out of these lending, but also actually our customers really truly loving us. Our lending net promoter score typically touches about 90. That means 90 people, on a net basis, 90% of our customers would recommend, of our people who borrow from us, would recommend us to a friend or family, which is, I think, an incredibly strong score to sustain over 17 years.
So I'm interested, if things go wrong, you're going to just write off the loan, like absolute worst case scenario.
This is true. So whenever things go wrong, before things go wrong, we try to provide our customers with tools that can help them be on top of that. There's a tool called Borrowing Power, which actually they can sign up for free. That helps them monitor their credit and see what they can do to improve it. We provide a number of such tools to just help them with that. That said, we understand that, in life, shit happens, right? And in those cases, we encourage them to talk to one of us and one of our people, who manage these customers and vulnerable customers. We would signpost them to charities who could help them. In fact, we want to fund many of those charities either directly or indirectly. And in the worst case, the loan is written off.
Okay, and so it still must make economic sense, because I know that you said when you announced acquisition that you expect it to, oh gosh, that's the microphone, increase revenue by 20% by sort of 2024, 25. So even now, during this cost of living crisis, the risk of having to write off several customers is massively outweighed by the amount of money that you can make from those loans.
This is true. So if you are lending responsibly, then I think there are a few things to it. It's one, you're lending to customers where you believe that actually making that lending and the consumer borrowing it can improve their finances in the longer term. And in that sense, there is a virtuous cycle there. What I have also been surprised actually is been as up until now, the very limited impact we have seen of the cost of living crisis, particularly on our customer base. So we did make some proactive decisions early last year in terms of factoring in future inflation into affordability, and thus tightening our lending criteria. But that combined by, I think, the UK customer being kind of resilient and being adaptive by reducing spending. You can see that everywhere, that spending hasn't kind of kept in line with inflation. That's the consumer making the more responsible choice for them, has meant that credit performance has been actually relatively benign, I would say. It's gone back to pre-pandemic levels, but it has remained more or less there and has been remarkably flat over the last 6 months. And we were fully expecting that over the winter, we would have more customers actually falling behind. We haven't quite seen that. So I'm kind of cautiously optimistic about it. But that said, this is the kind of risk that we need to measure, we need to factor into our business. And what at Zopa we are very different is that we've had the track record of doing that over 17 years, including the last financial crisis, through COVID, and now cost of living crisis. And throughout that period, our loans have actually made money, either for us or for our investors. And that's a track record we are pretty proud of.
Interesting. And that, having done those loans for a while, obviously,
Yeah.
so in a way, you're right up against Klarna, which has the largest market share in terms of the point of sale
Yeah.
solutions in the UK. But you've been engaging with regulators for a very, very long time. So Klarna's been sort of proactive in a lot of things like reporting to credit agencies because they've got a big team.
Yeah.
We're seeing smaller buy now, pay later firms, pure play providers, potentially falling behind on that because their compliance teams are smaller.
Yeah.
What kind of business model do you think is best set up for contending with the regulatory changes we're going to see? Is it neobanks like yourself? Do you expect more banks to move into the space because you've always been engaging with regulators, and when those smaller players start to fall behind, there's more market share?
Yeah, so I think what we have seen is that there is clearly a strong consumer demand for products like this. Of course, if it's served in the right way, then maybe growth will not be what a lot of the BNPL lending that has happened in the last 2 to 3 years might not have been sustainable. So I don't expect the same trends to continue. But the consumer demand is there. Retailers have seen the benefit of the improvement in sales that they see from this, and thus I would be expecting that retailers will continue to actually be able to subsidize and fund some of these financing operations. So I see BNPL as being a long-term part of the overall financial ecosystem. It's not going to take over the world, but it'll be a meaningful part of the financial system. But to succeed in it, I think there are a few things that you need to do. One is, I think, making sure that you're focusing on, as I said, where you can have sustainable unit economics. For us, that's in the larger ticket size. I don't think it makes sense to finance a pizza through a BNPL proposition. I don't think that quite works. But if you're financing, say, a washing machine or a refrigerator, then I think there is enough margin that you can actually absorb some of the unforeseen losses, but still make money, and it'll make sense from a customer standpoint. And I think you'll generally benefit all parties in the ecosystem. So it's people who can actually take on those longer-term cost of funds, longer-term lending, fund that at a pretty low rate on a consistent basis, and actually manage the risk of lending and manage regulators would be the biggest winners here. And that is actually a relatively small set of customers, set of people. I do feel neobanks who have done lending well, and I think that's a very small list, would be one of the winners amongst this.
And I guess you have a bit of I don't know, I could call it like a second mover advantage in a way. You've seen all the criticism going towards the buy now, pay later sector in recent years, and you've also seen how much money it can make.
Yeah. Or lose.
Or lose.
Yeah.
What are where else are buy now, pay later firms going wrong at the moment ahead of regulation, and what are the other areas of focus you'd like to see?
Yes, I think if I go back to why did buy now pay later succeed, I think I talked about some of the good reasons for consumers to actually use it. But some consumers were using it probably for the wrong reasons, partly because the promotions were misleading in the sense that people didn't understand that they were getting into credit and what the repercussion of not paying it back could have been. Partly because or credit was being extended to people who probably could not pay them back, and that was the reason they were using it. So if you cut out those two sets and just focus on the consumers who are taking it on because it's rational for them to take it on, where the basket size is large enough that you as a provider can make money, and kind of part three, those consumers can actually respond affordably, easily, kind of repay your loans. Then I think you have a winning business model, and I think a lot of the BNPL providers were probably not focusing on that, and they were just kind of extending credit because people were taking it. And that's where I think the biggest problem they have had is less about regulation, it's actually more about bad debt, right? Where as soon as interest rates went up and so on, consumers were just not able to kind of stay back, and bad debt has actually been the biggest thing that has killed a lot of these players.
lastly, really quickly, how do you plan, obviously it's very early days at the moment, but how do you plan on making it very clear to consumers that it is a credit agreement?
Well, so I think that there's a well-trodden path from the FCA around, how a credit agreement needs to be presented. And of course, this is not fully regulated, so we can't follow the same path. But the important thing is to be able to say that this is credit, simple as that. B, if you don't make repayments, be very clear in a disclosure that you are expected to make these repayments. And if you don't make these repayments, your credit bureaus can be negatively impacted. And we might try to collect this debt from you. So if it's those disclosures are made pretty clearly upfront, then I do think that makes it easy for customers to understand. Taking their explicit consent to actually look at their credit bureaus, understand whether the lending is affordable or not, again, makes it clearer to the customer that this is a credit agreement that they're getting into. So it's those things and those disclosures that I think can make a huge difference.
Okay, great. We're out of time, but thanks so much for
Thank you.
the conversation.